traders, welcome to Charts and Coffee. Hope everyone is having a good morning. We are kicking off a twofer today. We've got the CPI that has already come out. And one of the questions I often will get is, Rog, what did the CPI mean? And frankly, it's two things. What do the equity markets and the bond markets and the currency markets think it meant, right? Even metals, if you take a look at gold, what does that think it meant? And all we need to do is look at the direction, right? If you take a look at the direction of the reaction, clearly the number was perceived as good. Because when you start taking a look at actuals and year over years and month over months and what was the consensus versus the actual, et cetera, it can get very, very dizzying. So why don't we just go to where we want to be able to trade the impact? And there you go. That's what that CPI number was. We'll circle back to Forex Factory to take a look at what the actual data was. I haven't even looked. This is where my focus is at. So you take a look at the S&P moving higher. I guess it kind of liked it. Bond yields, not only is that up, bond yields are reflecting lower yields. So already some of you who've been watching Charts and Coffee for a while are thinking, hey, Rod, this is probably indicative of what? A more certain rate cut outcome for November and December. We can take a look at that as well here in Charts and Coffee. And then also lower yields, higher indices where bad news is good, or in this case, lower inflation would be bullish, right? Just like a lot of jobs, non-farm payroll is generally not going to be initially bullish, right? As they say, a lower jobs number would be. We're still a little bit in that upside down world, but not when it comes to inflation. Cooler or flat inflation is usually going to be perceived as encouraging the Federal Reserve to stay on track with their rate cuts. All right, well, bonds are moving higher. We're likely seeing gold move higher. So that would be the GC. There we go. And here's another place we can look. What did the dollar do? What did the dollar do? And the best way to look at that is head on over to the 6E. So the euro is a perfect inverse look at the US dollar. So what does that mean? Euro US dollar is the biggest market, is the biggest symbol of all markets. And when we take a look at the 6E, we're looking at nearly a 95+% correlation that's negative or inverse, which means if the euro shoots straight up, that means the US dollar is moving down. And this is a significant move for the euro because it had been under 3 days of some pretty heavy selling. And here we are taking about half of that move back. And again, this is dollar weakness. Dollar weakness will occur when expectations are for the U.S. central bank to cut rates. That's one of the catalysts, and a major one at that. So the currency of any country is going to be weaker when there are more imminent expectations or more clear paths to the rate cut. All right, so that's what we've got in the wake of CPI. Now, granted, at 2 p.m., we have another little event. Some guy named Powell is speaking today at 2:30. And the FOMC is slated for 2 p.m. I'll get the rate statement. So that's really going to be either the cherry on top if you're a bull. Now, if you're a bear, I guess depends on where you're looking, but this is clearly very, very bullish. All right, so let's take a peek then at what's going on at the NASDAQ. All right. And what do we have here? Well, we've been talking for some time here in Charts and Coffee and also in the Sector Secrets Mastery that we don't want to be short. We don't want to be short when the indices are moving higher in uptrends at that. So for a while, there's been this persistent, well, if it's not sell in May and go away, and I hope everyone listening to me now knows that is absolute bunk. It's not true. It's not even perceived properly in the context of what it means. Just because something gets repeated a lot doesn't make it true. So there is oftentimes during summer a certain amount of apathy, right? Sell can also mean flat. It doesn't have to have a bearish connotation. Clearly, a tendency, a saying that rhymes, cannot eclipse what's happening on the chart. The NASDAQ's moving higher, gang. We saw a sell-off into the WWDC keynote in Apple. And then yesterday, someone shot it out of a cannon, right? We've seen NVIDIA make its about 7% pullback post split. And now it's back to, holding at least. Its uptrend is going to open up around 123 this morning. So if you were looking for some kind of catastrophic worldwide developers conference sell-off or some sort of catastrophic post-split, something exceeding, say, 10%, that's probably the wrong side of expectation, right? So as long as we've got our measuring stick out there and it's rooted in data, it's rooted in what typical reactions are, most of us know, hey, NVIDIA's made its pullback. I would like to see more. We could see it at 230 if for whatever reason, whatever Powell says is perceived as not in line with the Fed fund futures. Okay, so I mentioned we do two things. One, let's jump on over. There we go. Let's jump on over to our CPI. Okay, so what was the it was cooler. There you go. Core CPI was expected to come in at 0.3. The previous was 0.3, and there it is at 0.2. What is this? Oh, okay, I don't know what that is. Pop it up on my screen there. CPI was cooler. That's month over month. Here's year over year. Everything was cooler. So this points to, hey, Jerome, time to cut rates, but how soon then becomes the next conversation. Now, clarity for November, December alone would be great. And an increased expectation for September would be bullish. And again, I'm talking bullishly because for crying out loud, we're in an uptrend, right? Okay, so June and July, nothing's changing there. In fact, let me just refresh this. It's been about 30 minutes. We should see some. So no expectation, gang. Nothing about today has been or is expecting a rate cut. So we can take that off though. Take that off. Now, we're taking that off the back burner. We're taking that clear off the conversation, off the table. But July, it's still likely going to be a hold. But this column for a cut is about as prominent as it's been in a minute. Again, we're going to likely hold in July. But here's where it gets interesting. That is a significant change. Those of you that have been following along in Charts and Coffee, those of you that are members of the Sector Secrets Master, you know what a big difference is. So let everyone in on this. This was neck and neck, 40 some odd percent on each one of these columns. Take a look at the cut column. It shot up to 62.8. Now, where it is now is not necessarily where it's going to be after the press conference. So the presser starts at 2:30 Eastern. So it may not be here, but for the first time in a long time, I'd say at least since March, we're seeing September back on the table. Doesn't mean we'll get a cut, but now let's move out to November. November is a cut, right? That's where this data using the Fed Fund futures is sitting. December is clearly showing there is going to be at least one, if not two, and now 3 rate cuts are absolutely back on the table. That would presume September, November, and a December quarter point cut, or skip September, quarter point cut in November, quarter point cut in December. All right, that's what the data shows. This is not me speculating. This is straight up a futures contract whose sole reason for being, right? Whose sole reason for being is, could we see a change in the rate at each meeting? That's it, right? Bonds are going to speculate on a lot of things. Dollar can move based on a lot of things. This is only looking at what is that Fed funds rate going to be at each one of these meetings. And you can see the contracts correspond with each meeting. So this is definitely a significant shift to what we've been typically seeing. And they will move around, believe me. So we're just looking for an average of what we typically see. All right, so as always, let's go and get to your questions. And back on over to the S&P, and we'll kick off the morning. Can the FOMC reverse the trend? Sure, but well, think about what they'd have to say. In order for the FOMC, so for those of you that are concerned, Rog, what if the FOMC comes out? What would they do? Powell is unlikely to reverse the trend. What would it need? Powell would have to come out and clearly state that they have no intention of rate cuts this year. That's what he'd have to do. Their goal is never to be that clear. Their goal is never to paint themselves into a corner. So could they? Yes, absolutely. But I mean, aliens could hover over Manhattan too, right? These are all possible. Are they probable? Probably not. Eddie, to your point, Could they? Yes. Will they? Likely not. Maybe a pullback, right? Maybe a pullback. So that's the way I would look at that. If he's not as dovish as the Fed fund futures sit in front of the rate statement and his press conference, then yes, what will happen is that we collectively as traders and investors would have to recalibrate our expectations of what we thought the CPI meant or what we thought the rate statement meant and go, oh, that's what he meant. And that's why that 2:30 press conference can be so chaotic, because it's really a reshuffling of, oh, we thought you meant this, and oh, you're saying that. If there is such an event like that, if he's out of line with where the expectations are. And believe me, the Fed fund futures, where the equity market sits, Jerome Powell is clearly and most definitely aware of it. So if he does start to change his tone, it's purposeful. It's on an accident, right? Okay. What do I think about Netflix for a short-term swing? I would want to wait until after Powell, Philip, but this is the way I would look at Netflix. So always structure first. Not knowing what time frame, short-term swing could be 1 hour. For me, for my lingo, short-term would be a 1 hour setup, which is definitely a buy if we pull back to about 645 to 642 and a half. But this is where I really like the setup. Okay. So first of all, Netflix was up yesterday. So I'm just going to say it blatantly. Buying calls on an up day does one thing and one thing alone. It makes us need someone else behind us willing to buy even higher. Right. So buying at highs is always a precarious thing unless you feel based on, you think, forget feel, you think based on your analysis, you see in the evidence of your analysis that you're at the early stage of the launch. I would not say that's the case where we sit today at 653 at all. This is not for me where I'd want to build a long position. Where I'd want to build a long position is a little bit lower in the range. So either the daily price movement range, if we move down there, say between 2 and 3 p.m. Eastern today, or this Darvis level at about 620, call it 626 and a half. So the closer we are to the lower end of the range, in a choppy range, this is not a trend any longer. It's not a downtrend. It's just not an uptrend anymore. So it's bullish chop. In bullish chop, I want to be positioned at an oversold support level so that when we get up to, say, 664 and a half, I have the option to move to break even. I have the option to scale out. And then if the momentum kicks in, I've got half of my position or maybe 2/3 of my position still open to benefit from the follow through. But a lot of traders buy into highs, presuming that there's folks behind them. And sometimes I think it would benefit those folks to actually use a rear view mirror, look back and say, oh, I might be the market top. Who's been there and done that, right? So to prevent that, what I would say is look at the structure, find the oversold or support level, position yourself there, and then take advantage of this range that we're stuck in. But I'm definitely bullish, right? So whether you want to do a 1 hour short-term swing or something a little bit longer term, I just need a little bit of weakness, right? To wake up this morning and buy Netflix at 652 is not my jam. Yeah, I would not recommend that. But I do like the long side, and I think a swing's a great idea. Absolutely, Philip. So triggers, price triggers are timing. And a lot of traders, especially when they're options trading, they will put on spreads in a way that seems as if they're not looking at a chart at all. Well, it's going up and this is what it's going to cost me. And they get lost in Greeks and they get lost in all the minutia of options trading. I'm telling you right now, 30 years, I don't look at Greeks. I'm going to go so far as to say you don't need them. If you look at the chart and you buy a pullback into support within the context of a trend, people ask me, Rog, what's the delta? Honestly, I don't care, but I have noticed anecdotally, it's about 50 on the low end and not quite 70, but somewhere between 50 and 70 on the delta. Does that matter to me? No, what matters to me is we've seen price at a certain level before. Based on price or volume or volatility, I can presume it will hold. That's where I'll put my trade in. So don't get too lost in putting in some kind of spread or looking at the delta. All that matters is if I can look behind me and say, oh yeah, I'm at the front of the line on this buy and there are people willing to buy higher, right? That's all that matters. And there are things that can help us increase the probability of that. One, get in early on breakouts by defining where the breakout is at. Two, do what I'm recommending, which is buy the lower end of the breakout range, right? So buy the support of the eventual resistance breakout that we're looking to take advantage of. Meta is a great example of that. All right, if you want to see, okay, Rog, what does that look like? Go take a look at the chop and then the breakout in Meta, and you'll see what I am talking about. And then the last part of it is, obviously today, the timing. So use the Federal Reserve, right? Use the volatility of it. Maybe if there's some weakness, we could capitalize on that. All right, what are my thoughts on Starbucks? All right, SBUX. Richard, Starbucks is trying to organize into an uptrend. It's not quite there yet, but it's still below the 200. So be aware that it's a little bit more in the bearish hemisphere. If you think about what that does, right? Why is that 200 so important? If you look at scanning software across the globe, one of the most basic requirements is for a bullish scan, very commonly, I'm just talking about common criteria, is that a stock is above the 200. And so when Starbucks is going to land somewhere, it may not land in a place that's garnering a lot of attention because it's below the 200 and it's not an outperformer in the group of stocks that it's in, the consumer discretionary. So what's one knock against it. One thing in its favor is it's trying to turn into an uptrend, even though it's in the bearish hemisphere. So it has the ability to be strong, but to get attention below the 200, it's got to have a couple of good up days, because remember, the vast majority of traders are like little T-Rex, right? They're little short hands reaching for the keyboard saying, what's making higher highs? Let me buy that. What's moving? Remember that scene in Jurassic Park? Don't move, otherwise it can't see you. Most traders and investors operate through the markets like that. If it's not moving, and if it's not moving up, they're not going to do anything with it. Which is why buy the dip is often, a meme and maligned and made fun of. And yet, it does work as long as the structure is there to suggest continuation, right? That's why the trend would be so important. So I'd say wait a little bit longer. Let's see how it fares today. But I would be cautious, but it would be a buy. All right. Again, from the daily price movement range, maybe even this area around 79.10, where the 21 propulsion is. JP asks, are the financial stocks a good sector to start looking at calls? I'm not there yet. JP, not the whole sector. Bank of America, yes. BAC is the only one that is on the radar in the Sector Secrets Mastery. Next up is eBay. And long swing on the daily. Yeah, if you want to play a mean reversion, if you want a really nicely stacked level, I'd say between 52.03 and 51.85. If not, you're at the aggro level of the mean reversion on the daily at about 52.5, if you like that narrative. Again, everything I'm saying would apply to every stock we're talking about applies to what I'm saying about the Federal Reserve. And whether or not between 2 and 3 o'clock, between the rate statement and probably the end of the presser around 3, what does Powell do? We don't know. We don't know. It could fly higher. It could pull back. It's the pullback that I want to try to take advantage of. So I love that everyone's looking at the long side, because that's where we're going. Right? I love these perma bears stepping in and saying things like sell in May and go, wait. First it was sell in summer, right? Sell in May and go away. But no, now it's new June now, and then it'll be July. No, then follow the trend, right? Don't follow the isms. Don't follow the rhymes. Follow the trends. And that's where we sit right now. All right, gang. That's a wrap. I'm going to jump on over into Sector Secrets Mastery. If you haven't checked out what we're doing there yet, head on over to sectorsecrets.com. You can check out how we day trade in the morning. We have scalping sessions twice a week. And Lorna Bot, by the way, I've been getting emails that people want 3 scalping sessions per week, but we'll see what happens. We have 2 scalping sessions per week where we not only scalp with you, but we teach you how to do it on your own in the room. We have our position portfolio, just picked up McDonald's in that. And we also have, of course, our swing trades. So we'll be looking for swings today. It's a good window for it. And I love what y'all are looking at, those pullback buys. All right, gang, be good to each other. I'll see you tomorrow. We'll see what the Fed had to say today when I see you in the morning. Be good to each other.